Hello, everybody. What's going on? History in the making taking place here. At least I think it's history in the making, a 40-year history. Look at that 3-month yield at 4.66%, crushing these yield curves. Today, we're going to talk about that, but we're also going to hop into what to expect going into tomorrow's data drops. You're watching the Stock Market Brief Show. Let's get into it. So welcome back, everybody. We're looking at the 10-year, 3-month yield curve. We discussed this yesterday, and we're talking about, hey, this looks like it's going to get to minus 100 basis points of inversion. And holy cow, we're taking nosedives. The rate at which this is moving to the downside is absolutely stunning. We're now 95 basis points inverted. The most I can see dating back 40 plus years. I don't have history going back before the 80s. And I pulled up the Fred website to see if they supplied it. And this is pulling into, I believe, the 70s. And we still don't have it there. So it's even more than 40 years. Take a look at how deep that inversion is. Now, it's important to note that when we get these inversions right below this zero line, it's likely that a recession follows. A recession is this gray area, this gray box. So inversion, recession, inversion, recessiono, inversion, recession, inversion, recession. Deepest inversion, no recession yet, apparently. And I tell you what, the stock market, man, I can't explain it. Taking a look at the heat map today, whoa, a lot of red on the big market cap names. Once again, Microsoft got hit, Google got hit, Amazon got hit, Tesla got hit. Another 3% there. Apple, right? They bounced off their highs. We discussed that. And, they were up yesterday, and it was just a little technical bounce, a dead cat bounce, at least for right now. Now, energy was up. Energy had the better of the trading session. If you look at energy, it was pretty much the only one in the green other than communication services. And energy got hit and whacked pretty hard. If you actually take a look at the weekly expected moves for energy, here was the upper, here was the lower, and we closed the week right here in the center. So day one, we got hit hard, right? And then we gapped down, and then we pulled right back into the weekly expected move, which we discussed, and we just came back into it. So we got hit to the downside, and now what are we doing? We're still down on the week despite seeing these gains. So we talked about energy quite a bit yesterday, so I'm not going to dive too much into that one. I do want to hop into some safety ratios momentarily, but first we'll look at the Fang Man ratios, because if you look at these big names that have been getting hit, I want to show you how their performance is relative to the SPY. So we'll look at Meta. All right, it's coming up a little bit, getting above that 50-period EMA. But look at Apple. Apple has a horrible one where it's pointing basically straight down, so it's underperforming the S&P 500. NVIDIA is kind of flagging right here. It's actually from an absolute standpoint. Semiconductors is too. So be careful there as this kind of came down. Google, relatively neutral, but it is just sitting right around its lows from relative performance. We know that Microsoft got whacked back these last 2 trading days, so not looking good there. Amazon also just completely just getting obliterated here from a relative standpoint. Netflix is surprisingly the only one that's holding up above a trending 50-period EMA. And then you have Tesla relative to SPY, and that thing's been getting crushed too. So from a relative performance, you can see that people are rotating out of these growth, the bubbly names that ran forever during the 2021 run up. Okay, now let's get into the curve, because this is going to potentially change come after the jobs report, which is tomorrow in the morning. So 5:30, this is an hour before the market opens. We'll talk about expected moves, but let's take a look here at what this stands at now so we can kind of later. So as it stands now, our current target rate for the Fed's fund rate is 425 to 450. Okay, 425 basis points, so 4.25% to 4.5%. Coming into February, right? So that's the next meeting date. They're not going to be doing the rate stuff in January. So February, there's a 59.1% chance probability that they will be raising it to 450 to 475. That is a 0.25% basis increase. Now, a lot of big people have been talking about the Fed pivot or the Fed pause, and they're waiting for that to happen. And if that happens, they don't want to get squeezed. And a lot of fear is out there. But as we know from the FOMC minutes, the Fed looks like they're on their path to take down inflation and then also continue quantitative tightening. Okay, so February, we have this. Now, I want to roll out further. Okay, this looks a little bit different, but just bear with me here. 59.1% probability, right? This is February. You got March, May, June, July, September, etc. Okay, and then you have the probabilities for where those rates will go. Now remember, 4.5 to 4.75, there's a 59% chance. You take a look here, 59.1% chance. That's all that's showing. It's just a different look. Okay. Now, so there's a 59.1% chance of a 25 basis point hike here. Going out to the March meeting, guess what? The probability of another rate hike is here to go to 475 to 500. This has changed slightly from the past. Okay, and then coming into May, which is almost halfway in to 2023, okay, we might be looking at a possibility of 5% to 5.25%. And that right there is currently the terminal rate, I guess you can say, where it's kind of pausing out there. Okay, so May can hold it there, June can hold it there, July can hold it there. That's a while away to have rates at these levels, okay? And with the Fed continuing to using quantitative tightening. Now, I don't know if that's going to be the case, or if something's going to break, or if we're going to go into recession, or if they're going to have it a pivot earlier. I don't know yet, okay? That's to remain. That's I don't have a crystal ball. I can go off what the probabilities are right now. But as it stands right now, the market and also the Fed, the Fed is saying that they're going to be holding rates for longer, and the market is pricing that in. Okay. And then after going into September to November and then December, you're looking at, oh, okay, now it's going to come down a little bit. Okay. But to where? 4.75 to 4.75 to 4.5. These are still high rates for the entire year. And as we know, if they do continue quantitative tightening and they hold rates at these levels for this long, it could cause a lot more destruction. It forces people to start savings, right? This causes recessions. This is not a good sign, as we're seeing, as we have the jobs data coming out, non-farm payrolls and unemployment rate coming out tomorrow. I don't know if this is going to hold in most recent data, for example, like Amazon. I know there's a couple other companies that have been reporting that they're laying off staff. I think it was Salesforce. It's hard to say. So we'll watch to see what takes place there. I believe that most consensus is 200K. And from what I've been seeing, gathering out there, I don't have it with me, it seems like we could very well, based off of ADP, come in at consensus or slightly hotter than consensus, which could be pretty bad for the markets, right? Seen as if unemployment or non-farm payrolls is up, market might perceive that as a potential, opportunity to just sell into because the Fed's going to continue its current path. Now, if we take a look at the dollar actually did break out slightly today of this wedge pattern. The SPY was down, or the S&P 500 was down slightly, but still no break out of this consolidation pattern. It looks and feels like we'll get one tomorrow, but we'll talk about that here momentarily. Now, the dollar, this is interesting to me. As we're coming into this report, the dollar, looking at the zones, is actually now at the upper point of its range. Remember, silver was at its upper point of the range, and now it's back down to the lower. Right? So if you're looking for opportunities to scale into positions, not to say that this is the bottom, but opportunities to scale in. So silver came back down. A couple other that I've been paying attention to, consumer staples and utilities. On yesterday's video, we discussed that the rate of change was going down for these two. Well, they got hit, and they didn't just get hit softly. Utilities got hit, one of the hardest sectors today, 2.16%. Consumer staples was down 1%. So I looked into add a few basis points, just positioning, just to have some long on my current portfolio. So that's one thing that I was looking at. Now, the reason why I say this is interesting here is because the dollar is kind of extending out. However, it is still in a very tight trading range. So it leads me to believe that even, first and foremost, I'm not going to be taking crazy directional bets right now in the first place. I want the market to digest it. But it is telling me, saying, hey, because the dollar's correlation is so strong to the S&P 500, this is already reaching a high point. Perhaps that might come down, might jump the S&P 500 up. But the question then would be really to where? And that's where this comes into place. Tomorrow, the implied volatility is at 34.89%. This is the SPY on the 15-minute time frame. We're looking tomorrow at roughly a $5.25 expected move, which takes us to 374 to the downside, 384 to the upside. And what would that do on the downside? That would take us to where? It would take us to where the market priced in at the very beginning of the week, right? 374-ish, right around there. That would actually technically start to break this trading range to an extent, at least potentially this little tiny trend right here, this channel that we're watching at. Now, if the market perceives it as good news, we can very well go right up to 384, which would take us to right here at the top of this gray channel. And really, we would still be, once again, within this crazy chop trading range. So that is what I'm looking at tomorrow. I'm looking at the low end and I'm looking at the high end here. Remember, this report comes out at 5:30 in the morning, PST time. So that is 1 hour before the overall cash market opens. Now, overall, right now as it stands, we're below a 5-day moving average. It is in neutral stance, so it went from declining to neutral. So this could be a potential accumulation where we start to go into a short-term markup phase. Always a possibility, but this also can very well just be a bear pennant or, a potential ascending triangle, but in bearish context. Remember, we're below all these key moving averages. The 200 is sloping down, the 20 period is sloping down, and we've been trading below the 50. The longer we stay there, the more this can potentially start turning around like so. Now, if we do start moving back up tomorrow, as we said, it'd be about 384, which would put us right here just at the top of this pattern. Okay, now we've seen 2 sigma moves all the time, so we'll be aware of that too as well, but we're probably gonna get a lot of the trading action right out of the get-go. Now, a couple of good things that did take place today is, actually, before I get into this, I did discuss that I was looking at XLP and XLU. Let me get a little bit more clarity as to that. We're looking at the relative strength on the defensive or the safety trade. So gold, for example, right? We talked about that on yesterday's video, and that did pull back today. It's in strong performance relative to the SPY. So you have money rotating in here, most likely because, we do already see the money rotating in there because it's going up. However, you can see that the performance of gold is outperforming the SPY here since really December of last year. And then you have XLU. It did get hit back today, but it's still above a trending 50-period EMA. So it's coming back down, but it's overall could be potentially putting in a higher low. It doesn't mean, remember, relative strength does not mean that, it doesn't mean that, if this goes up, utilities go up. No, it just means that that sector is performing stronger than the S&P 500. So if they both go down and this line goes up, this means that utilities is just going down less than the S&P 500. XLP also been in a nice, why am I stuttering there? Steady uptrend with the 50-period EMA also sloping up nicely. TLT is rather neutral, but it is above that 50 EMA. That is, once again, neutral. Defensive names also been trending up, which is nice there too as well. And then XLV was another one I'm keeping a close eye on there. It is trending up with a nice trend there on the 50-period EMA relative to the S&P 500. Now let's get into a couple indicators here. Today, the NASDAQ Summation Index, we did have the parabolic star tick over. Okay, so this is interesting. This is telling me that we could very well be in the early stages of a trend change. Now, nothing's guaranteed. You can see potential whipsaws. However, this has been very good at identifying changes in trend. So even if we get it potentially hit down tomorrow and this still remains to stay above it, that could be a good sign for the NASDAQ composite. Now, that could mean some tech stocks might get a bounce. Remember, big tech has been getting hit big, all right? However, there's various different industries within the NASDAQ composite that we've been seeing getting strong breath. And you can see that with here, the NASDAQ McClellan Oscillator has been trending up there too as well, getting some positive breath. So that'll be a very interesting thing to pay attention to here in the next few trading days. If we take a look at the NYSE Summation Index, this one did not click over, but it is still curling back up. So I'm waiting for that to see if that'll tick over. It looks like if we don't get some crazy down gap tomorrow and then just structurally just damage, this looks like, it looks like it's going to start ticking down and then might mark a potential change in trend there too as well. So as bearish as everything looks, right? And how historic we're starting to see things take place. This tells me like, hey, we got to be open for the opportunity for bounces from things that were hit heavy. So you got to be very tactical, maybe look to short on higher lows that when you see bounces, as we're seeing some potential changes in trend, but doesn't change the overall longer term trend, which we know has been bearish of lower highs and lower lows. But we must be careful in this environment because there are many bearish things taking place still. Hope today's video helped out, everybody. See ya.